Welcome back to the Deep Dive. Today our mission is, well, it's focused entirely on the foundation. We're talking about the boring, essential, non-sexy details of personal finance that, actually determine whether you succeed or fail.
You really do.
We've taken this comprehensive stack of sources covering what we're calling the 4 essential pillars of financial security. So, banking, protection, inflation, and growth.
And we're not just, defining terms here.
No, this is about application.
We're showing you how these pillars, your cash, your risk defense, your inflation strategy, and that growth engine, how they absolutely must lock together.
In one seamless system.
Exactly. The
Yeah.
difference between actively managing your risk and just sort of passively letting your finances decay is vast. And most people, they unknowingly choose decay.
Okay, let's unpack this. We're going to begin with the foundation, what you call the optimized money hub. I mean, this is where your money actually lives, right? Your bank accounts.
And where most people are accepting a guaranteed loss of money every single month.
Through fees and missed interest.
It's astonishing. It really is. That checking account should be your financial command center. It's meant for frequent, easy transactions.
But the traditional banks, they see it differently.
They see it as a profit center. They charge these monthly maintenance fees, $10, sometimes $15. That's up to $180 a year.
Just to access your own money.
Right. And it's completely avoidable.
Online banks, credit unions, they almost all offer free checking. So that's rule number 1. Just eliminate that $180 annual fee immediately.
Yes. But here's where the economics really start to shift. It's the savings account.
The contrast is huge.
A traditional savings account at a big brick-and-mortar bank. It's basically financial quicksand.
The quicksand is a good word for it.
They're paying, what, maybe 0.01% APY. So if you have $1,000 saved, you earn 10 cents.
A year.
A year. That's not saving. That's just accepting a guaranteed loss of purchasing power.
So on the other side of that, you have the high-yield savings account, the HYSA.
Offered mostly by online institutions.
And right now, those rates are somewhere in the 3 to 5% APY range.
And this isn't just about earning a few extra bucks. This is about weaponizing your liquidity. Your emergency fund goes from being this deflationary thing.
Money that's guaranteed to lose value.
Exactly. To an active compounding asset that's still there instantly when you need it.
Okay, so that's for liquid cash. What if you know you have money you won't touch for a specific period?
Right, like a down payment in 2 years.
Or something for retirement 5 years out?
Then you can maximize those returns even further with a certificate of deposit, a CD. It's time locked, so you sacrifice that immediate access.
But you get a higher locked-in rate.
You do.
Wait, I have a question there.
Yeah.
If an HYSA is paying, say, 4% and it's totally liquid, why would anyone lock their money up in a CD?
That's a great question, and it gets to the core trade-off. Liquidity versus a maximized return. Sometimes a 5-year CD will pay a point or two more than whatever the current HYSA rate is.
HYSA rates can change.
They're volatile, they move with the market, so that's where a more sophisticated technique comes in. It's called CD laddering.
Okay, let's make that really clear for everyone listening.
So the laddering strategy, it's all about keeping your liquidity while still maximizing those locked-in rates. Instead of putting, say, $50,000 into one big 5-year CD,
And locking it all up.
you split it. You create 5 $10,000 chunks. You buy a 1-year CD, a 2-year, a 3, a 4, and a 5-year.
Ah, so you've staggered them.
You've staggered them, and every single year, one of those CDs matures. It becomes liquid cash again.
And you can either use it or
Or you can reinvest that matured CD into a new 5-year term, locking in the highest rate available at that time. It's like you always have a tranche of cash coming due while the rest is earning at its maximum potential.
That makes perfect sense. Okay, before we leave banking, let's just circle back to fees. You said they are absolute profit centers.
They are, and the most predatory one by far is the overdraft fee. Traditional banks charge $30, $35 every time you overdraft.
And they can cascade.
Oh, they cascade. If you make 3 or 4 small purchases while you're negative, you could be looking at well over $100 in fees in a single day.
So the takeaway from the sources is clear.
Eliminate fees, maximize interest, and really try to choose institutions that have just gotten rid of overdraft charges altogether.
All right. So we've hardened our cash foundation. Now let's talk protection. We need a robust defense.
We do.
Insurance, at its core, is really about risk transfer. We pay a small, predictable cost, the premium, to avoid a large, unpredictable catastrophe.
And that catastrophic principle is everything. Insurance should cover events you simply cannot afford from your savings.
A house fire.
A house fire that would mean bankruptcy, $1 million cancer treatment that would mean financial ruin. You need insurance for that.
But not for everything.
Right. If your dental cleaning is a predictable $100, but your annual dental premium is $600, you are way better off just self-insuring. Pay the bill yourself.
Okay, let's dive into health insurance. The sources distill 4 key terms we have to understand. First, the deductible.
That's what you pay first out of your own pocket before the insurance company starts to pay.
Then you have copayments and coinsurance.
Right. Copayments are those fixed dollar amounts, like $20 for a doctor's visit. Coinsurance is a percentage. Maybe you pay 20% of the bill after you've met your deductible.
But the term that the sources say is the most crucial is the out-of-pocket maximum.
This is the absolute firewall. This number is the most you can possibly spend on covered healthcare in a calendar year. Period.
So once you hit that cap,
Insurance covers 100% of everything else. It is what protects you from unlimited financial exposure.
okay, but help me understand this. If I have a $5,000 deductible, why does an $8,000 out-of-pocket max matter so much? They sound pretty similar.
They are not, and that difference can save you from financial ruin. Imagine you have a major surgery in November. You hit your $5,000 deductible.
Okay.
But because of your coinsurance, you might keep paying small amounts until you hit that $8,000 maximum by the end of December.
Right.
But then the calendar flips to January. If you need follow-up care, your deductible resets to 0. That out-of-pocket max is the only thing that protects you from having to face 2 catastrophic years back to back. It's the annual spending cap. That's the number to focus on.
Got it. Okay, shifting to auto insurance. Liability coverage is key here.
It covers the damage and injuries you cause to other people,
And it's listed in those 3 numbers, like 100, 300, 0, 100.
which means $100,000 per person for bodily injury, $300,000 per accident for bodily injury, and $100,000 for property damage, and carrying just the state minimums?
Which are usually really low.
Shockingly low. It is profoundly penny-wise and pound-foolish. If you cause a serious accident, those minimums get exhausted instantly. Then they come after your personal assets, your future earnings.
You have to carry substantial liability. And also, don't overlook uninsured or underinsured motorist coverage.
So important. And it's often very affordable. It protects you when the driver who hits you has no insurance or not enough to cover your medical bills.
Let's talk homeowners. The big distinction here seems to be how losses are paid out.
It is. You have actual cash value, or ACV, and you have replacement cost coverage.
Give us the easy analogy for that.
Okay, ACV says, if your 10-year-old roof is destroyed, we'll pay you what that 10-year-old roof was worth.
Replacement cost minus depreciation.
Exactly. It's like trying to sell an old car and only getting a low trade-in value. The recommendation is always choose replacement cost coverage.
Because it pays for a brand new one.
It pays the full cost to replace the damaged item with a brand new equivalent version, no matter how old it was. It's the difference between getting a check for half a new roof versus the full cost of a new roof.
Now here's a product that the sources say consistently offers surprising value. Umbrella insurance.
Yes, this is an extra layer of liability that kicks in when your auto or homeowner's limits are exhausted.
And for what, maybe $150 to $300 a year, you can get $1 million in extra protection.
It's the financial equivalent of a surprisingly cheap $1 million warranty on your life. It protects your wealth, your future income. Anyone with significant assets or a high-earning career should absolutely have it.
Okay, so we've secured ourselves against catastrophe.
Right,
But here's where we face this invisible enemy.
right.
We've optimized our cash in that HYSA, but there is a silent threat attacking that wealth every single day. Inflation.
The continuous erosion of your purchasing power.
And the danger isn't just what happens in 1 year, it's that it compounds.
The math is chilling. It really is. If inflation just runs at a modest 3% annually, your money loses half of its purchasing power in only 24 years.
Think about that. Half of what your savings can buy today is just gone.
Within a generation. And what the sources make very clear is that inflation doesn't hit all sectors evenly.
Right, which leads to a real decline in living standards for a lot of people. General inflation might be 3%, but look at housing, healthcare, education.
College tuition, adjusted for general inflation, is up something like 180% over the last 20 years. That's a targeted financial assault.
And yet this decay creates a really strange paradox when it comes to debt.
Inflation is often called the debtor's friend.
Explain that.
If you have a 30-year fixed mortgage, your payment is the same every month for 30 years. But as your income ideally rises with inflation over time, you're paying that same fixed amount with dollars that are worth less.
So the real burden of that debt actually shrinks.
It shrinks over time.
So if cash is constantly being degraded by inflation, and bonds often struggle to keep up, we get to a pretty chilling bottom line.
The bottom line is that holding cash and low-yield bonds over the long term guarantees you will have real losses in purchasing power.
Cash gives you safety, it gives you liquidity, but it is not the growth engine.
Never. We need a growth engine.
So what does this all mean? If cash is losing value year after year, we have to move beyond just saving.
We have to move to dedicated, disciplined investing. And we have to be really clear about the roles of each, because mixing them up is one of the most common and costly mistakes people make.
Okay, so let's define them. Saving.
Saving is all about safety and liquidity. It's for short-term needs, anything you'll need within, say, the next 1 to 3 years.
And investing.
Investing accepts higher risk. It sacrifices that immediate liquidity for the pursuit of long-term growth. This is money you won't need for at least 5 years, maybe more.
And the power of compounding makes this distinction just non-negotiable.
It does. I mean, look at the math on a $100,000 portfolio over 20 years. If it earns 1%, like in a savings account, it grows to about $122,000.
Okay.
But if it earns 8%, which is a typical stock market return over the long run, it explodes to $460,000.
There's a massive difference.
That right there is the power of compounding.
Yeah.
And it leads us directly to the most costly mistakes, which are entirely behavioral. They're not intellectual.
Mistake number 1.
Only saving and never investing. Sacrificing all that potential growth because you're afraid of volatility. And the second mistake is the exact opposite.
Investing money you're going to need soon.
Yes. Which forces you to sell at a loss during a downturn, usually because you're panicking.
So the consensus from these sources points to a very critical sequence, a harmonized strategy to get this right.
You have to follow this order. Step 1, you save 3 to 6 months of essential expenses for your emergency fund. And that cash must sit in a high-yield savings account.
Step 1, done.
Step 2, you save for any specific goals you have that are 1 to 3 years out. A new car, next year's tuition. That also stays safe in an HYSA or maybe a short-term CD.
And then step 3.
You invest everything else. Every single surplus dollar goes toward long-term growth, stocks, real estate, and you always use your tax-advantaged accounts first.
Speaking of tax advantages, for people with high-deductible health plans, there's a tool the sources highlight as absolutely essential, the Health Savings Account, or HSA,
It's often called the ultimate tax shield.
because it has a triple tax advantage.
It does. It's basically unbeatable. Your contributions are tax-deductible going in. The money grows completely tax-free. And if
Yeah.
you use it for qualified medical expenses, the withdrawals are also tax-free.
So it's an incredible secondary retirement vehicle.
It is. You're paying for all your future healthcare costs with money that was never, ever taxed.
And there you have it. We've hardened your cash foundation with the HYSA. We've shock-proofed your life with things like the out-of-pocket max and that affordable umbrella insurance.
We understood the stealth attack of inflation.
And we turned your money into a compounding machine by following that crucial saving versus investing sequence.
So now, the challenge, it transfers entirely to you. You have the knowledge. The sources are absolutely clear that consistency is what separates a modest financial life from a comfortable one.
Right. The difference between saving 15% of your gross income versus 25% over decades.
It's massive. It will absolutely dictate the quality of your retirement.
So let's leave you with the final provocative thought, which really echoes through all the greatest works on personal finance. The core challenge in achieving wealth isn't intellectual. It is, at the end of the day, entirely behavioral.
All the tactical knowledge we just shared, the CD laddering, the HSA strategy, it's useless if you let human emotion derail your growth engine.
It all comes down to overcoming that panic selling during a downturn.
Or the greed when things are flying high.
And the best way to do that.
You implement automated, systematic strategies. You basically remove yourself from the day-to-day decisions.
You remove your own emotion from the equation.
Because it's discipline, not cleverness. That is the ultimate key to wealth.